The average savings account in America at the time of me recording this video is paying a little bit over 0.4%, but I'm going to round it up this time to 0.5% just to be generous. But here's the interesting thing. If you take your extra money that you can go out and invest, you can invest in the bank and be an owner in that same bank. Now, as the owner, you are entitled to your share of profits. And some of these banks are making huge profits, which we all know. And when you become one of the owners of the banks, you are entitled to your share of profits. Now, how do you get that profit? One way that you can get the profit is through a dividend, which is literally a cash payment that the bank will give you for doing nothing except owning that bank. The other is through potential appreciation. This is through seeing the stock price rise. So if your bank makes more profit in the future, they could see the value of their stock go up. Now, I gotta give you the disclaimer, investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. I'm not telling you what to invest in, I'm just giving you examples to help you start thinking like an investor. When you save your money, you know your money is not really gonna grow, and you know that inflation is probably going to outpace your savings. Now, yes, you can move some of this money to a high yield savings account, but still the principle, the balance of the money that you invest is not changing. You're just generating some interest on top of that. But here's how things can change if you start thinking like an investor and you start thinking like an owner. If you were to go out and invest in the bank itself, for example, JP Chase Bank. At the time when we were recording this video, JP Chase Bank is paying out a dividend of around 2.4%. Bank of America, at the time we were recording this video, is paying out a dividend of around 2.8%, and TD Bank is paying out around 4.9% a year in dividends. What is a dividend again? A dividend is extra cash that this bank is giving to you. Is paid out quarterly, meaning every 3 months, for doing nothing except owning the bank. So when you deposit your money in the bank, your bank is giving you 0.5% of interest, actually less than that, the average bank account is. But when you work to own the bank, you become an investor, you become an owner. Well, now JP Chase Bank is paying you more, Bank of America is paying you more, TD is paying you more, because now you're working for the profit, not the interest. Now, yes, this comes with more risk. There's a chance that JP Morgan could go bankrupt. There's a chance that Bank of America could go bankrupt. There's a chance that TD could go bankrupt and the value of investment goes down. But you see what I'm saying here is now you started to think like an investor, where now you're looking for the upside, because if the flip side happens, where JP Chase Bank makes more money in the future, Bank of America makes more money in the future, TD works to make more money in the future, well, now the flip happens. Now, instead of losing all of your money in a bankruptcy, not only do you see the value of your investment go up, but you also start to receive bigger dividends, because if they're making bigger profits, they can pay out more dividends as well. This is why it's so important for you to understand this. It's not to hate banks and to say banks are evil, which is what some people do. I want you to understand the system, because the system is designed to keep a lot of people stupid, and the system is also there to profit off of people making stupid decisions. I want you to understand the game. I want you to understand this economic system. That way you can use it to your advantage. And that starts with you, number one, not spending all of your money. Number two, stop relying on the bank to finance all of your stupid purchases. Now, once you start doing that, you have some extra money. Now you start saving some money because you have some extra money. It's better to save than to spend all that money or to go finance things that you can't afford. Now that you start saving, you are now at the next level. That's when now you want to start being even smarter with your money, because your savings are not going to outpace inflation. Yes, you can get a better return if you put your money into a high yield savings account, but still, a high yield savings account might pay you 3, 4, 4.5%, but you're not seeing any growth in the principal value of your investment. This is where now, once you build your savings cushion, you can also start looking at investing. It's not bad to save your money, but I want you to understand the alternative, which is investing your money, because investing is how wealthy people become rich. Wealthy people don't become rich by saving all their money. They become rich by owning assets. What are these assets? Companies, stocks, real estate. When you invest in a stock, when you invest in a company, you become one of the owners, and now you're working for profit. You're working to see the value of the stock go up. Is it guaranteed to make you money? No, absolutely not. But this is how wealthy people have become wealthy, and this is how they build wealth. Now you can start flipping the script. Maybe instead of paying the credit card company interest, you can start generating money through your credit card points, take the money and buy the credit card stock. Again, I can't tell you what to invest in, but I want you to start thinking like an investor instead of a consumer, because that credit card debt is making the credit card company rich. When you own the credit card company, you get rich when the credit card company makes money. And this is where I want you to understand how this economic system works, because our economic system is designed to benefit investors, period. We're not taught how to do this. School doesn't teach you to become an investor. We're taught to get a good job and then work and then hopefully be able to retire one day. But how do you actually do that? How do you actually build that wealth? The way you build wealth is by becoming an owner, by becoming an investor. And that requires you to, number one, not spend all your money and then take some of your extra money and use this money to invest. Again, I'm not telling you to invest in banks. There are ETFs to give you exposure to banks. There are a lot of ways to do it, but you don't have to invest in this particular company, this particular fund. You got to understand that investing is how you build wealth and then find the right investment for you. The banking system is not designed to teach you how to be better with money, because if your banker was teaching you how to be better with money, their commissions would also be going down. They wouldn't be selling as big of mortgages, as many car loans, and as big of car loans, or as much credit card debt, because now you would be smarter and not financing those things and not going into that deep of debt to buy the things that are not putting money in your pocket. So it's not in their best interest to teach you. It's in your best interest to learn the game, build your financial education, and become an investor. That way you can use the economic system to your advantage. Again, if you want some more resources, you can check out Market Briefs, which is our free financial newsletter, which will break down what's happening in the financial markets. Plus, you'll also get our investing masterclass free as a bonus. The link is for you down in the description. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.